Hey everybody, Marty Mazur, good morning. Just a really quick video for you. It's the 23rd of October 2018. Dow's down 430 points as I speak, and the retest of the recent low is happening as I speak. And this is something we began talking about when I first presented this chart to you on October 17th after we had a huge up day on the 16th. I suggested then that the volume setup was not inspiring me to go rushing in with a whole bunch of cash and buy stocks right here, despite some of the pleas from folks like Goldman Sachs, that it's time to rush in and buy. The volume setup was telling me no, that's not the case. It looked a lot like this volume setup in June. As you can see, we came down, came up, then retested back in March, and of course back in January. Did not look like this bottom, this true bottom where stocks just went up multiple days in a row on really big upside volume. We didn't have that look, and then as it continued and as I updated the chart, I said it was looking more bearish. So it was more and more looking like a test. We're getting that test right now. Now we can talk about the catalysts for today's decline. I can talk about Caterpillar's earnings, which were stellar, by the way, but the outlook expressed concerns over tariffs, and that should be of no surprise to you. Weeks ago, I said this is what we have to look forward to in the third quarter earnings season. We've also been saying all year that it's really the market that'll ultimately inspire cooler heads to the table, because folks, like it or not, agree with it or not, a global trade war isn't going to work for the global economy for sure, absolutely not for the US economy, and certainly not for the US markets. And political success going forward really relies on a healthy economy. So I think that if the powers that be don't know it already, they're learning very quickly that despite a really good macro backdrop that has really kept stocks nicely afloat, ultimately, the more you push against that scenario with tariffs and threats of trade war, the more you're going to weaken that setup, or at least weaken sentiment. And you're going to see sellers come into the market in a big way, and buyers are not going to be inspired to buy under those circumstances. And that's what we're seeing right now. The general conditions, as I keep talking about, remain decent. There is, in our view, based on what we see in the data, little risk of a recession in the foreseeable future. If that changes, then of course we'll have a different discussion, and we'll be exploring ways to try to mitigate the negative impact of the next recession and the next bear market. Again, you don't want to go there until that's really in the cards, because if you do, you end up getting whipsawed. Cooler heads prevail, and suddenly we are back to all-time highs. And the areas that were a little more concentrated in materials and industrials and financials that haven't had a good go of it of late actually are the ones that come back the strongest, not technology that's had such a good year because it's been largely exempted from the trade war. So folks, again, the macro backdrop instructs us to stay the course and to live with the volatility, as I've preached many times. When the fundamentals are sound and the technicals continue to point to a continuing of the long-term trend, we stay growthy despite the volatility. When the fundamentals roll over along with the technicals and we no longer have that bullish outlook, then we have to revert to a more defensive posture and mitigate as much of the potential bear market as we possibly can. Once again, not where we are today. Actually, I would say that this is precisely what needs to happen to inspire better thinking about trade and tariffs and so forth going forward, and different tactics to deal with the real issues, which isn't trade. The real issues are things like intellectual property theft, and that's problematic, and that needs to be dealt with. In the meantime, the market's got some technical damage that's being done that's going to have to work out. We look for capitulation. Generally, when you have a legitimate correction, it ends on a big, gigantic sell-off with huge volume and so on, and then you begin to see a bounce with really good volume like we saw back in here. Obviously, that's not what we're seeing right now. Right now, we're seeing a stressful situation, a lot of short-term volatility within the context of an ongoing bull market. So I'll leave it there. Of course, there'll be much more for you on the blog in the days to come, and I'll talk to you again very soon. Take care. Bye-bye.